Hi, my name is Lisa Winchester. I am a Vice President for CBIZ Insurance Services in the Mid-Atlantic region. You need a comprehensive risk management plan because, well, without one, you're vulnerable to losses that you otherwise could have prevented or mitigated if you had had a plan. Ultimately, the objective is to prepare your business for a loss and maintain the vitality of your business. There are 5 key steps to creating a risk management plan, and the first step is risk identification. It's the most important because without identifying risk, you're not able to treat what you don't know. There are several ways to identify risk. We use physical inspections, we review contracts and financial statements, workflows. We also use industry checklists. So the second step is analyzing those risks that you've identified. I recommend using a risk matrix. On one axis, you're going to measure the likelihood of an event, and on the other axis, you'll measure the severity or the impact that that loss event has. And then you'll be able to prioritize which types of risks you want to address first. The higher the severity and higher the frequency of losses are the ones that you address first. So the third step in a risk management plan is risk control. Risk control is a method of mitigating or preventing losses. And effective risk control is going to reduce the likelihood or reduce those impacts that you previously identified. To pay for losses, there are 3 primary funding options. The first one is to retain the loss, and that's when the company pays for the loss out of their own funds or borrow the money. The second is to buy insurance, and it's the most common means to finance risk. The third is a contractual risk transfer, in which, in an agreement, one party agrees to pay for or indemnify you for loss. Alternative risk financing is maybe a hybrid of retention and risk transfer, whereby you take on a greater portion of risk through high retentions, loss-sensitive plans, or captive insurance plans. Your organization's risk is going to evolve over time. Your losses will develop, and your risks may change, so you need to keep your plan updated and review it regularly. An effective risk management plan will give you control over how your organization manages risk and losses.